Welcome. Once again, I'm Bill Bosshardt, Director of the FAU Center for Economic Education. And the goal of this session is to teach you a little bit about teaching insurance and then also to introduce you to the insurance game. And I'm always excited to do the insurance game because if you're going to do one activity with insurance, you want to play the insurance game. And so we will do a brief introduction to insurance, and then we will show you how to play the game. Okay, so let's talk a little bit about insurance. So once again, when you're talking about insurance, we're going to have to sort of review a little bit the types of insurance before we play the insurance game, which has multiple types of insurance in the game. So I'm using a PowerPoint that is from Take Charge Today, which is an organization that has a lot of financial literacy materials. You will be provided, of course, a copy of this PowerPoint as well as the original PowerPoint. I've edited out some of the things, but we can send along the full PowerPoint, which you may want to use in your class, or you can go to the Take Charge Today website and you can find the video or the PowerPoint there as well. Okay, so let's talk about different types of insurance and why insurance is important and why it's important to have insurance. And so let's go ahead and take a look at that. I'm just going to, oh, there we go. Okay, so why do we have insurance? Well, risk is an important reason, right? That there's all sorts of things happening in the world. Something's good, something's bad, but these are elements that we can't control in its entirety. And so humans sometimes really don't like to have tons of risk, right? Most of us are risk averse. And so we prefer not to be always having all these changes in our lives. And so we have to do things to manage risk. And there's a couple of things that you can do. Number one is you can have emergency savings. And so people recommend different amounts of things. But here they say at least 6 months of expenses set aside to cover sort of these unexpected expenses or unexpected things happening. You want to be prepared, right? You have to have set aside something for things that are unexpected. In other words, you are self-insuring against certain smaller kind of events. You say, oh, something bad, my toaster broke. Okay, I got to get a new toaster. I hadn't expected to buy a new toaster, but I can handle it because I have a little savings put away. But for bigger things, you need insurance, right? And so for large health costs or automobile accidents, these things are expensive. And so even if you do have emergency savings, it might not be enough to cover everything, some of these costs, particularly the medical costs. And so therefore we buy insurance. Now, you can ask the students, well, what are unexpected events? And certainly kids can think of all sorts of things that might cause some problems for people. So what do? You buy insurance. You buy insurance policy, right? And the policy is just a contract between your insurance company and the insured that says, well, what are the terms of the policy? The coverage then talks about what kind of risks are covered, and that's important, right? Because when you buy an insurance policy, you want to make sure you know exactly what's covered and what is not. And sometimes there's always a little mix-up, and you think you're covered for something, but then suddenly you're not. And so you want to be careful about that. The policyholder is then the person who owns the insurance policy, and the premium, of course, is then what you pay for the insurance. And so the insurance company is doing it for monetary reasons, and so they expect a premium, and in return they cover these losses. Okay, so how does insurance work? And so this is the economics, right? So when you think about economics and economic concept, this is really what is behind the insurance here. And so number one, suppose there are 100 people in an health insurance group. So we're doing health insurance. Insurance is about pooling people together to share the risk. And so you get 100 people together. Actuaries, know what's sort of the probability of an event. And so suppose there's a 1% chance that any one of these 100 people could get sick and require $10,000 in medical care. Well, okay, on average, then that means out of the 100 people, one of them on average is going to get sick and require 10,000. So how does insurance work? Well, okay, well, we don't know who's going to get sick, right? That's the thing, right? You don't know which of the 100 people. But if everybody in the 100 puts $100 in, right? 100 people, $100, they collectively collect $10,000. And that $10,000, right, can be used to then pay for the cost of the one person who gets sick. So the result of this is, of course, everybody, gives up $100, but nobody loses more than that, right? In to cover that 10,000 for you being sick. So the bottom line is that 99 people, of course, don't collect anything, but they do get the peace of mind knowing that that if it had been them, right, they would not have had to pay so much. And so that's how insurance works, right? And so most of the time we don't use our insurance, right? Most of the time we're not sort of filling out collection or filling out claims all the time, right? It's fairly rare. I know, for example, I've had homeowners insurance now here in Florida for now going on, probably 20, 22, 23 years. Never filed a claim, right, on my homeowners insurance. And so, yeah, I mean, I'm lucky, right? I mean, you prefer that not to be the case. But I've had neighbors who have had something happen to their house, and then of course, then they did file the claim. So that's the bottom line here. Okay. So the insurance really what it does is it shifts then the loss that from the individual to the insurance company, right? So that's really what's going on here. The benefits of insurance, well, okay, yes, obviously, if something bad happens to you, then the payments that well, okay, the payments that you receive from the insurance policy can far exceed your premiums, right? So if something bad happens, if a hurricane hits your house, I mean, it's like I've been paying, lots of money for insurance over the years. But if a hurricane blows off my roof and damages my home in a significant way, I'm going to come out ahead, right? I'll have won, right? But so it can be a big benefit there. And then of course I know that there'll be security. You don't have to worry about every time there's a hurricane bearing down. You don't worry quite as much that, well, look, my house could be totally destroyed. And if you didn't have insurance, then that's it, right? Your house is destroyed, and what do you do? Okay, there's varying types of insurance, property and liability, health, long-term care, disability, and life, right? So there's lots of different types of insurance, that protect people and individuals from sort of different kinds of risks, right? And of course, the best thing to do is the best outcome is to have insurance, but then never collect it, right? Because that means you enjoyed the security, but you haven't had to go through the pain of having something bad happen to you and then getting reimbursed for that. How does the insurance process work? Well, yes, each event occurs resulting in a loss. You file a claim, and the claim is a formal request to the company to pay for something. The insurance company will make sure that the claim is valid and also that the policy does cover that claim. And if so, right, then the homeowner, the policyholder pays the deductible. And so that's important, right? Is that many policies have deductibles, and this is what the policyholder pays before an insurance company starts covering the remainder cost. And there may even be co-insurance after that, which means that there's a fixed percentage of the remaining costs that are still borne by the policyholder. So let's give you an example. Suppose that Louise has a health insurance policy with a $500 deductible and a 20% coinsurance. And that just basically means that Louise will pay $500 of any medical care plus 20% of whatever the remaining is. And so if there's a $5,000 medical procedure, that means Louise pays $500, the deductible, plus there's what, 4,500 remaining, 20% of that is 1,400. So that means that the insurance that Louise will pay 1,400 and the insurance company pays the remaining 3,600. And so it's very common for policies to have at least a deductible, and some deductibles and co-payments as well. So obviously Louise still needs to have funds to pay the deductible and the co-insurance as well, right? And of course, if Louise did not have insurance, Louise would have been on the hook for the full 5,000. So with insurance, it does save Louise in this case, instead of only having to come up with 1,400 instead of the 5,000. So let's give you another example. Carlos was involved in an insurance accident resulting in 3,788. He has a policy that says $500 deductible and 0% co-insurance. How much does he pay? Well, he pays $500, right? He pays the deductible. The insurance company is going to pay the rest, the 3,288. So, once again, the students should know how to sort of, well, what is a deductible, what is co-insurance, and how they work. And, this game that we're going to be looking at in just a second, talks about that. So, how much, what insurance would you choose? Well, there's often trade-offs that people have here, right? And so let's look at this two policies. Here's one policy for health. Premiums 300, deductible is only 200, co-insurance amount is 20%. By the policyholder, or do you take a policy that's 2,000, deductible is 200, and 0% though on the co-insurance? Well, it's sort of a trade-off of what you want, right? If you think that you might have frequent smaller bills, well, then maybe you want that lower deductible. But on the other hand, the other policy is lower expense, but you have a higher deductible. So things that they have pros and cons to all these things. And once again, a lot of it is sort of what you think is going to work for you in terms of your risk or what you think your risk is. So anyway, so risk is the possibility of face financial loss, and we face all sorts of risks over time. Well, death, auto accidents, health problems. And so what do we do about these risks? Well, there are sort of, three things you can do. There's only, these are the three ways you can deal with risk. Number one is you can assume it, right? You just live with it, right? And in essence, self-insure. And for smaller risks, like, you go to, you go buy a toaster oven, right? And you check out at Best Buy or something with your toaster oven, and they offer you the warranty, extended warranty, and that's really kind of like an insurance policy, right? They're basically offering you, the question is, well, do you get that? Well, generally the answer is probably no, right? Because the fact is that, well, even if it were to break, this is something that you can self-insure. That, okay, yeah, you buy the toaster oven, it was $150 or something, and after 2 years, if it breaks, you go, oh, that's bad luck. But you deal with that, and you just get yourself another toaster oven, probably another brand, but there you go. So you're self-insuring for these smaller risks. What else can you do? Well, you can reduce the risk, right? So you could, for example, if you don't have, if you have a high deductible on your health insurance, right? Maybe you decide not to go skiing or something, or you don't go skydiving or something, where there's a possibility that you might injure yourself, right? Or when you bike, you wear your bike helmet, or if you're driving, you don't drive as recklessly, as you take more caution. So you can do things to reduce the risk as well. So so that's another thing that you can do. But the last thing, of course, is that you can transfer the risk to other folks. In other words, the insurance company, by buying insurance. And so that's what we're going to look at here. So the lesson we are looking at, so you say, okay, where am I going to find this lesson? There are two places. The Minnesota Council on Economic Education was actually where the lesson first appeared. And then the St. Louis Fed, love the series of lessons. There's actually 10 lessons here. You should probably look at them all. They're all pretty good. But not all on insurance. They're on a variety of topics. This is yet another resource, right? So that we've seen in the in when I've talked to you, we've looked at next gen materials. We've looked at materials from the Council for Economic Education, and now we're looking at materials from the Minnesota Council or the St. Louis Fed. All sorts of places for materials. But here we go. We have the St. Louis, Fed liked the Minnesota materials so much that they put them on their website, and they revamped them a little bit and made them a little snazzier in their layout and whatnot. So you have an opportunity. So this is where you find them, right? Find these lessons. So we're going to go through the lesson. So say when you say, oh, I like this lesson, where are the full instructions? You'll find the full instructions there. So I'm going to go through now. Obviously this is a tape thing, and I do apologize. This was supposed to be a live version, but actually, I'm having cataract surgery, and actually probably right now when you're watching this video is exactly when I'm going to be having the cataract surgery. And so it hadn't the surgery got moved. I had cleared this day so I could be with you live, but they rearranged it, and so therefore you're getting the tape. And so this means we can't do sort of the same kind of group thing that I'd hoped. But so what I'm going to do is I'm going to describe to you sort of how the game works, and this is important. So it is important that you break your kids up into groups. Okay, so 4 to 6 groups. And each person makes their own individual insurance choices we're going to see in just a second. But each group is going to have something happen to them, right? And so I like this activity because they're going to be able to work together on when something happens to them. They figure out what that means for their types of their insurance, and so it is a very interactive game as well. But it's also important because then the kids get to see. It's like some groups, bad things will happen to a group, and obviously the value of insurance is then illustrated. Even the groups that aren't in that group, they look and see all the bad things that's happening in a group. They're like, oh, well, sometimes insurance really does make sense. And there are, of course, groups then that not much happens to, right? And that's life, right? I mean, some of us go through life and we never collect a dime on any of our insurance, and well, that's a good thing, right? But there's some of us who yes, this rash of bad things happen. You say, well, I'm glad I had insurance against that kind of stuff. Okay, so you break them into 4 or 6 groups and get them around. And so basically what they're going to do in this game is they're going to buy insurance, and then we're going to see what happens to them and how that insurance works for them. And so those are sort of the 2 things. So the first thing that you have them do is that you have them choose insurance, okay? And so you give them a budget, 4,000. You can you don't even need to necessarily give them a budget. You could just let them spend as much as they want, but usually you want to give them a little trade-off, so that they don't just buy the maximum insurance for everything. That they understand that they have to make trade-offs between the types of coverages that they might want if they have a budget of 4,000. You could lower the budget a little bit, maybe 3,000. I've done that, worked that. So then they understand that sometimes things are very difficult. But anyway, but they recommend 4,000, and probably until you sort of get a feel for the game, that's where you should go with. And they're going to have a choice, right? To spend it on either health or auto or renters or disability or life insurance. And so those are the 5 choices they have, and they have different options here, right? And also, I'm going to now. So there's 2 versions that you can do. You can do the paper version, which is what you'll get at the St. Louis website. But also, though, what I've done is I've developed a spreadsheet, right? And so a second way, and so I will share this spreadsheet with Aaron Standish. And this might speed up the calculations. And so if the kids do have, you have access to into computers and Excel, they can go ahead and do the insurance game with the spreadsheet. This makes it a little easier because it'll just add up the totals and stuff a little quicker. And so I'm going to use the spreadsheet just because it looks pretty much like what you see in the game, but then all the addition and stuff will be taken care of. And so the first thing then the choice is that, well, okay, the kids are going to choose a certain type of insurance. And so here for health insurance, you basically have a choice between, well, let's see, cover office visits are 20, 100% hospitalization, 80% hospitalization is only covered. That basically means you have 20% copay on hospitalization. Option 3 is only hospitalization, none of the doctor's visits. Just for the heck of it, I guess I will go with option 2. Okay, so it'll be $20. So you see that it then, if it were the paper version, they'd fill in 2,800, but this does it automatically for them. Let's see, automobile insurance. Let's just do liability. Let's hope we don't get into an accident, huh? So that's option 3. That's only $500. Let's see, renter's insurance. Maybe, what, I'm not going to bother with the renter's insurance. So let's just go with that. So no insurance there. And disability, let's go ahead with option, I don't know, 2. And once again, 160. And then I'm going to buy some life insurance. And I'm going to go ahead and buy a lot. So I'm under my budget, and it's okay. By the way, and you should reinforce to the kids that it doesn't have to be 4,000, right? You can be a little under 4,000 is just the maximum. So I'm at 3,640. Okay, so then once the insurance has been covered, the second part of the game is then, well, things start to happen. So we're going to play year by year, what's going to happen to you. Well, okay, so and then you see how your insurance works. So let's go back here to our thing. So what's going to happen is then I'm going to draw. So there would be 4 to 6 groups now, and you will draw a card, right, from a regular deck of cards, right? You are going to, that card will then determine what happens to that group, right? So you're going to draw 1 card for each of the 4 to 6 groups. Okay, and then based on that card, right, these are the things that can happen, right? And so, for example, if a 2 is drawn and given to a group, that means for that year, they had the bad thing that happened to them was 1 office visit, and the loss is $200. So it's $200 to go to the doctor, right? Okay. And if you're uninsured, that's probably correct, right? They're going to charge you a couple $100 for that. If you draw an ace, here you go, ace, you're going to have a minor fender bender where you have automobile damage of 1,000, but you didn't hurt anybody, so there's no liability there. If you draw a queen, you get 2 months disability. Apparently you make $2,000 a month, and so you'd lose $4,000 or something. Okay, and then the only thing is that, okay, well, we're going to play multiple rounds, right? So we're going to go around, and you can play as much as you want, right? I mean, we're going to do maybe 4 rounds just as illustration, but if the kids are having fun, you can go 5 or 6 rounds. If you're short of time, you can go just a couple of rounds, and there you go. So just use it to fit the time that you have. Then the next thing is some of these events, are rarer, right? I mean, so, really bad things don't necessarily happen a lot, but they do happen. And so to make that sort of part of the game, if you draw a 10, okay, in 1 year, okay, then you look here, theft of electronics. But in the very next year, and it's got to be the very next year, if you draw a second 10, okay, then it's really bad, right? 2 10s in a row means that you've had 20 offices, major hospitals say $80,000, right? Basically 4,000 of offices, it's in 76,000 hospitals state. So that would be a very bad thing. And of course, the worst thing in the world, of course, is the dreaded double ace. And if a group gets 2 aces in a row, that's it. That results in death. Okay, yeah, you have your insurance for that. Okay, so we're going to play 4 years, okay, and the idea here is that you're wanting the kids to write in the losses with insurance and without insurance, and the whole idea of this game is to let the kids see, well, would I have been better off with insurance or would I have been better off without insurance, and that's really what we're the goal here. So we're going to go back to our spreadsheet and start to play the game. So I have a deck of cards here, right? So very good, and I think I made it so I hope you can see me. It's I think I remember to go ahead and put the camera on, and so you draw a card, and so we draw a card and we see a 2, right? Okay, so 2. So the card drawn is a 2, and the risks, based on the risks, okay, what's happened? 1 health visit. Okay, now, insurance premiums, okay, so it fills in the insurance. So with insurance, you have, in the case, because remember, my insurance, all my totals was 3,640 down here. And you see insurance premium 3,640. Now I need to explain this opportunity cost because this is an important idea. Is that okay? When you're talking the cost of insurance for that year, so you pay the premium of 3,640. Not only do you use the 3,640, but you could have had the interest on that, right? If that money, if you had just let it sit and not gotten insurance, you could have put it in the bank and gotten interest. And so the opportunity cost is that lost interest. And that's part of the cost of the insurance, right? And by the way, that is the benefit for the insurance company because they hold on to that money and use it to earn the interest. So that is though a cost for you, and they go with 5%, and that's $182. So the cost of the insurance, right, is the premium plus the cost of the opportunity cost. Now, in this case, right, we've had now what's the loss without insurance? So if you didn't have insurance, you'd have to pay for that health insurance visit. That would be $200. Now, these sort of the orangish kind of things are what the kids should be filling in, right? So they fill in the card that's drawn, and then it generates all this stuff. But now they have to figure out, well, what's the loss with the insurance that you have chosen? So you go back and let's see, what did I choose? I chose $20 visit for my copay, right? So, okay, for 1 visit then, I don't lose $200, right? Because I have an insurance, I will lose my copay though of 20 bucks. Now it tells me I'm correct. That's the kind of nice thing about the spreadsheet is set up that the kids then get that reinforcement if they get it right, and if they don't get it right, then they know they have to sort of think about it a little bit more. Okay, so we continue to play. Ignore down below here. We're going to get to that in a little bit here. Okay, so we continue to play. Oh, get my cards, right? Okay. And what do I got here? I got a jack. Okay, jack. Okay. Jack is a J. I put that in, or you can use the drop-down box. Oh, that looks like a minor accident. Okay, so minor accident looks like $3,000 in damage. Okay, let's see how much I've lost here. Okay, my automobile insurance. I kind of underinsured here. Only liability, nothing on collision. So, So that means, right? Okay, no liability. So I wasn't, but I'm on the hook for the full 3,000 because basically my insurance didn't cover anything. Correct. Okay, maybe made a bad decision there, right? Didn't get the greatest of insurance. It was cheaper, but yeah, now just 3,000. Uh-oh. Okay, hopefully life will get better here. Let's do another round. Okay, another round. What is it? Jack again. Oh, crud. Okay. So, once again, so another Jack. And if you notice here, though, it's now different, right? Because this is now two Jacks in a row. And as it turns out, well, it's probably not surprising that if you had a minor accident that is followed up not too later with a major accident, it looks like you're a bad driver here. Here's the thing is that, well, okay, auto damage is $6,000. Liability is $20,000. And, the thing is that, though, with this insurance, though, at least my coverage here will be for the liability up to 50,000. Okay, so I at least get the liability covered. It looks like, though, my collision, I'm still going to be paying for the 6,000 in damage. Right, so I don't have to pay the liability. I still have to pay for the damage. Yes, and it confirms that I'm correct in terms of that. So there, the insurance saved me a little bit of money, right? I would have, without the losses, I would have had to pay 26,000, and I only ended up paying 6. So I saved a little bit of money there. We're going to do one more round just because I said we were going to do 4. And the 4th round is, what is that? It's a 10. And so if I put a 10 in, I see that, theft of electronics. It looks like it's $1,000 of electronics was stolen. Let's see, did I get it? I can't remember. It's like, did I get any renter's insurance here? I did not. Okay. And so therefore I am going to have to pay the full $1,000. That is correct. Okay. Now here's okay. So you play whatever rounds you want. It's got 8. I wouldn't recommend paying more than 8, but you can certainly pay more if things are going well. Kids are hooting and hollering. It's all okay. Okay. So the question is insurance worth it? Okay. Well, that sort of depends on what happens to you. But in this case, here, total cost of the losses without insurance. So this column here, 200, 3,000, 2,600, 1,000, you add those up, that's $30,000 and $200. So $30,200 would have been what I would have lost if I'd had no insurance whatsoever. Okay. So the question is, well, am I better off with the insurance? Well, let's figure it out. Okay, the insurance plus the opportunity cost, right? If you added up those up, so our premiums and our opportunity cost, 14,560 plus the 728 gives me 15,288. Okay. And then the total cost of my losses, right? So this is what I still had to pay, still with the insurance, right? And I got nailed for a couple of automobile accidents that to a total of $10,000 or $9,000. Okay, so you add that. So here's the cost of insurance, 15,288. Here's the 10,000, right? And so you add those. So with the cost of the insurance plus the losses I still suffered with the insurance, I ended up with 25,000 and 25,308. So you compare that to total cost of the losses without insurance. And you can see I am, in this case, still better off with the insurance, right? Because $30,000 is what I would have lost without insurance, and the cost of the insurance and the other losses with the insurance still was total of 25,000. So the kids fill in here yes or no, right? If they put in no, it would tell them no, that you're not right, you're not better. You were when you said I'm not better off with insurance. Yes, you were. So they fill in yes, and that is correct. And so this will vary, of course. Some groups, right? If you all you get is 2s, right? And so this is the fun thing with a spreadsheet is that you can kind of quickly figure out if you're better off with or without. If you had just done so in this case, right? You're better off with insurance because you had a couple of accidents, right? It saved you, especially with the liability, it saved you $20,000 on that second big accident. But there'll be some groups that nothing will happen to, and of course then they would have been better off without insurance. But that's the nature of insurance, right? And so if everything had been a 2, right? If we had just drawn 2, 2, 2, right? And then your loss with the insurance would have been 20, 20, and 20, right? In which case you spent a lot on insurance and to save only very little amounts, right? And so so the answer here would be, of course, no. And you'd been better off with the $800 paying those office visits yourself instead of having, the health insurance, all those other insurances. So it just depends on what happens. And of course, that's the same thing with life as well. Okay, so that's essentially the game. Let's talk about, the debrief. What would you talk to the kids about after you play the game? You'd ask them who wishes they bought more insurance. And of course, all the people that had bad things happen to them say, oh, I should have more insurance. Or the ones who didn't buy enough of a particular type of insurance would say, oh, I wish I had other types of insurance. Who wish they bought less insurance? Well, of course, anybody who nothing happened to would say, you know what, maybe it was overinsured, right? So what kind of things what kind of, you talk to them about what kind of things are covered, and you talk about the different types of insurance and talk about deductibles and what those things are. Now, one of the things about this game, so that's how you debrief it, and once again, having the different groups, they're going to be able to see that sometimes insurance works out, sometimes it doesn't, and it's really up to your own risk, right, tolerance, whether you want to buy a lot of insurance or not. Now, the one thing about this game is that I always like to sort of, and you can either talk with the kids about this, or at least, you know it, and if you want to talk to them about it, great. If not, that's fine. But this insurance game is very well designed because the insurance premiums are actually actuarially fair. In other words, basically, you're going to break even with the insurance. If you kept playing this, you would break even, except for the fact that you'd still lose your opportunity cost, right? So in the long run, because of that opportunity cost, you're going to lose. But that's how insurance is, right? I mean, the insurance company has to make a profit. So we know that in the long run, you are going to lose with insurance, okay? But the good news with insurance is that you have less risk. And so that's what the insurance company, that's the service that the insurance company is providing you. They're lowering your risk, and in return, of course, they're taking a little bit of that. What do I mean though? So to give you an idea, what do I mean by actuarially fair? So let's give an example, the renter's insurance. So option number one, $250 deductible, 5,000 loss. We're going to figure out what is the expected loss, okay, with that insurance. So insurance company has actuaries that calculate this number, right? Before they can price an insurance, they need to know the probability of something happening and then figure out how much they're going to have to pay, and then they can figure out what the expected loss is going to be if they sell a policy. And then, of course, they're going to price it so that they make that money. So for the renter's insurance, there's two things that happen. Something happens on a 10 or a king. Each of the 10 and a king, there's 13 cards of each. There's ace, king. You understand what? There's 13 of cards within each suit. So that means you have a chance of a 10 is 1/13 and a chance of a king is 1/13. And so if for the insurance company, if it's a 10, they lose $750, because if you remember, that was $1,000 loss. If you had the insurance, it'd be $250 deductible. That means the insurance company would be on the hook for $750. So they would expect, right, 1/13 of the time they would have to pay $750. On average, that's $57, right? And then the king comes up 1/13 of the time, and that's a larger loss. That's $3,750. That would be $288.46, which means their expected loss is $346, right? So the company on average is going to lose $346 on this policy. Which means they have to have a premium above that. And so in the game, the premium is $350. So the premium is just, gives the company just a little bit of profit. And remember also, though, they have your money, and so they use that, invest, and they make money from their investments with that money. But the point here is that it's a well-designed game in that they provide a very reasonable insurance premium, for the risk taken. And I've seen other games that aren't very well designed, that it's a no-brainer to take the insurance because they're offering great protection, and at a very low cost. And here, being actuary fair, it is much more realistic because insurance policies are based on actuarially, actuaries figure out the price of these policies, and so that gives you that idea. Okay. So once again, what this means overall, if you kept playing this, if you paid lots and lots, you'd expect that students will lose a little bit of money, right? Because it's actually fair, they're going to lose that opportunity cost in essence. And then also there is a little bit of sort of rounding profit, right? There's, $4 of profit, for this particular one. So once again, this is a very realistic kind of a game as well. Hints. I didn't give you the risks. In other words, the cards and what each card meant. Sometimes, I can't even remember the instructions, but because I play it different ways. But you could give them the risks ahead of time, right? You could say, okay, here are the risks. Here's the insurance. You make your decisions. And that might, it would be an interesting exercise. Now, a lot of them would probably try to calculate, whether it's worth it or not, and find out that actuarially fair is what they are. But it also might give them an idea of what all the different things that could happen. And how much they could lose if they didn't have insurance. So you might consider doing that. I don't, but you could. Once again, you could give them a little higher budget, if you want them to buy, or no budget if you want them to sort of understand the teachers, the thing. And then lastly, you say, well, what if I'm doing the paper game? How do I know what all the answers are, right? Because what should the kids be filling in? And of course, it's hard when you're going around the classroom, trying to figure out what, it's like read through each one. And so there's a cheat sheet that is included in the lesson that basically says that, okay, if the card is a king and the kid chose option 2 for the appropriate type of insurance, it shows, what that number that the kid should be filling in is. And so you don't have to necessarily, I recommend, by the way, you go through and make sure you understand all those numbers, but you don't have to sort of like recalculate it every time. You can just look at your sheet and tell them. Okay, so with that, I guess that is what I have for you today. The insurance came, and I don't save my changes, so I have a blank things. And so I hope you use the insurance game, because the insurance game is really one of the most kind of important games, I think, for teaching insurance. Insurance is something we don't necessarily spend a lot of time on. And so I think that, if you had to spend time on insurance, what would I do? I'd introduce them to insurance and the different types of insurance, and I'd play the game. And I think then kids would get to understand. And I think it's really important, and the reason I like the game is that, it helps kids understand that unexpected things happen. And the deck of cards illustrates that very well. It's like, oh, boom, this happens. And every year there's something that every life is that way. And kids don't think that they are exposed to risks. But what the insurance game does is it sort of shows them that there are risks that are there, and that that's something that's why we have an insurance. And if you don't have insurance, and heaven forbid you get the double jacks or double kings, and something bad happens, you realize that then you really, there is a purpose for insurance. And so once again, it's a fun game. Kids love it. You play the game. It's always a wonderful thing. And once again, it's like you draw that first ace, and then you go around the room and you come back, and everybody's looking to see, is the second ace going to come? Is there going to be a death in the classroom? Or anything, right? A single jack. And you should play it up too. It's like, be sure to announce all the cards, because once again, it's important that the kids see that, bad things or good things happen to everybody. Okay, so with that, that's all I have for you on insurance. I hope you enjoy the insurance game. Once again, it's one of my favorites. Okay, so enjoy the rest of the boot camp. I think you're on day 3, and I wish you good luck on the next day as well. Bye.